All right, it looks like people are joining. Welcome to June's edition of CORA College. My name is Justin Hewins. I'm one of the senior partners here at CORA Capital Advisors. Today's topic is on digital assets and cryptocurrency. Our guest today is Kevin Walsh. He is with Bitwise as one of their regional directors. I met Kevin back in 2023 at a dinner and had a nice chat about digital assets and cryptocurrencies. So we thought this would be a great topic to bring to our client base and people that are associated with the firm. So Kevin, feel free to take it away.
Yeah, thanks, Justin, and thanks to everyone who's joining on a Wednesday sunny afternoon. Well, it's sunny here in Boston anyway. What I thought I would do is break this discussion down into four different components. Talk a little bit about Bitwise, as Justin had said. I'm regional director here in the Northeast for Bitwise, and what our history and heritage is. Talk a little bit about the ecosystem, because there's a lot going on in digital assets. We will get to Bitcoin, I'm sure, because that's usually the headliner. But there's a lot going on in digital assets outside of Bitcoin, and I think it's actually very important to bring that to everyone's attention. And then talk about investment options and why perhaps digital asset exposure might make sense in the overall context of a diversified portfolio, and then certainly leave time for questions and answers. So Justin and Sarah, if that's okay, I think I'll proceed in that manner.
Yep, that sounds
Sarah,
good. So what you guys can do too for the participants is if you have a question, feel free to type it into the chat, and at some point in time, we will get to it. If we don't answer it right away, because the presentation is going on, I'll certainly try to circle back and get to it at the end.
Yeah, that sounds perfect. So a little bit about Bitwise, a really interesting story. Bitwise was founded in 2017 exclusively as a digital asset manager. As you can see on the screen, we actually launched the first crypto index fund, which trades and is live and well and is about $2 billion on most of the exchanges here, tickers BITW. We're known in the industry as really building our firm on the educational philosophy. So as we partner with family offices and institutions and RIAs like CORA Capital, our main job and objective is to bring education and information to them so they can make informed decisions as to whether or not it's a prudent way to go ahead and perhaps get some exposure. Our CIO, Matt Hogan, actually co-authored the CFA's Institute Guide to Crypto. We have industry-leading insights and education on our website. And I think the important takeaway here is we actually are solely dedicated to the space. So unlike other traditional finance managers that are much larger than Bitwise, that do a little bit of everything, we exclusively focus and only on the digital asset space. Sarah, if you could go to slide number 5, I just want to talk a little bit about our co-founders because I think they have an interesting background. There we go. I won't go through everyone, but what's interesting about Bitwise is a very good combination of technology backgrounds as well as traditional finance backgrounds. So as you can see in the upper left, our CEO and co-founder, Hunter Horsley, he actually came from Facebook. And for those of you that are familiar with Instagram, certainly if you have children, you're familiar with Instagram. Hunter was the mastermind and the product manager behind the launch of Instagram, Facebook, roughly a dozen years or so ago. He co-founded the firm in conjunction with Hong Kim, who is to his right, Chief Technology Officer, and Hong actually worked for the Korean military. He was actually an engineer at Google and was actually wrote computer code for the South Korean government. And then down in the bottom left is our Chief Investment Officer, which you may have seen if you follow CNBC or Bloomberg or some of the financial news networks that are out there. Matt was the founder of and CEO of ETF.com, and now Action serves as our Chief Investment Officer and has a fairly high profile in the space. Sarah, if you could go to the next slide, I just want to talk a little bit about our backers and where we came from. Here we go. Some of these names might be familiar to you, but in conjunction with some venture capital firms that we partnered with, like Highland Capital, Electric Capital, and Khosla Ventures, Henry Kravis from KKR, who has a long storied history in finance, is one of our financial backers, as well as Stanley Druckenmiller from Duquesne Capital. And then Kevin Warsh, not to be confused with Kevin Walsh, who is actually just named our Fed chair. was a financial backer in Bitwise as well. So it was good to see him get the nod for the current Fed chair as we go forward. Next slide, if you could, Sarah. As I mentioned, just quickly, we are very well known in the industry for providing educational materials. We have a Bitcoin and Ethereum libraries on our respective website. They're very educational, and our CIO, Matt Hogan, writes a weekly memo on the industry in general in terms of what's going on and current insights that we see taking place within the overall industry. Um, Sarah, if you could go perhaps to page 9, and I'm going to transition from who Bitwise is into digital asset ecosystem and recent developments. Um, this slide basically, I think, is the key to the presentation because I want to separate blockchains from crypto. Blockchain is actually the foundation. It's a immutable ledger, which is technology based, which basically fuels all types of cryptos. And there are probably not probably. There are way too many cryptos out there that we actually need or want. But essentially, it's an immutable ledger that allows transactions, whether it's financial or other, to settle 24/7, 365 instantaneously. Unlike our traditional payment rails where stocks still settle in a day, bank wires can take 2 to 4 days, and bills can take 1 to 5 days, depending on if your system talks to the other system that you're trying to make and coordinate that payment with. There is a lot going on in digital assets this year. I'm going to break it down into 4 different components. Number one is regulation, because the industry has been calling for and wanting regulation. It's starting to happen, perhaps at a slower rate than we would like, but nonetheless, it actually is happening. I want to talk about stablecoin adoption. I want to talk a little bit about tokenization, and then we'll finish up the developments with Bitcoin and how the consumer of Bitcoin has dramatically changed in the last 3 or 4 years. So let's start with regulation. Um, Last year, the first piece of real legislation was passed in conjunction with digital assets. It was known as the Genius Act. And the Genius Act, actually, which will go into law in 2027, brought regulation, clarity, and framework to stablecoins themselves. And what essentially said is, as a stablecoin issuer, you have to have the collateral backing that stablecoin issuance, just like a money market or a checking account would. So you have to invest in short-term or cash equivalents, and you actually have to be fully collateralized. That brought a lot of clarity and a lot of removal of a fear factor because now it's actually passed into law. Behind door number 2, and what we're essentially waiting for, is the passage of the Clarity Act. The Clarity Act has advanced through Congress. It's waiting in the Senate. It has advanced, but currently it has not passed. It actually advanced through the Senate Banking Committee about a month or so ago. And what that does is bring governance and framework to the overall digital asset ecosystem and determines which body and which government board will actually go ahead and be the enforcement agency for the Clarity Act. It's kind of a big deal, and we are anticipating that that will pass. But there's some lobbying against it for a variety of reasons, and some of the big banks in particular are kind of in an arm wrestling match. But hopefully that gets passed sooner rather than later, and will bring a lot of positive news to the overall ecosystem. Number 2 from a big theme is stablecoin adoption. And I'm not sure how familiar you are with stablecoins. They're not as prevalent here in the US as they are globally. But to give you a stat, which I think people are surprised by, is last year, globally, stablecoins did more in transactions than Visa did. And in March of this year, stablecoins actually, for the first time, hit $1 billion in global transactions. Simply put, stablecoins are digital dollars that are pegged to a fiat currency. So they can be issued in US dollars, they can be issued in pounds, they can be issued in yen. There's no fluctuation in their value, and they can actually be transferred globally across border, and it will settle like a text message. So a lot of the clogs that our financial system currently has are removed by the usage of stablecoins. There's a lot of institutional involvement in this. Fidelity, Bank of America, JP Morgan are all trying to issue their own stablecoins. The second largest issuer of stablecoins, known as Circle, went public last year in the fourth quarter and has actually had a very good performance record since that time frame. DoorDash. You have kids, you know DoorDash, right? Because you're getting Taco Bell deliveries at your door at 2 a.m. At a 35% markup. DoorDash was one of the first corporations globally to announce they are implementing stablecoin rails. Why is that a big deal? DoorDash doesn't have employees, they have independent contractors. They have over a million and they operate in 40 different countries. So they have to deal with refunds, payments, um, um, order flow, and they're in 40 different currencies, 40 different banking systems. The stablecoin issuance of that removes a lot of that friction in the system. So that's a real life example of where stablecoin adoption is coming to life. Tokenization, you cannot turn on CNBC or a financial news network and not hear about tokenization. Tokenization will allow securities to settle 24/7, 365. Unlike our current financial system, which has an on-off switch, right? The New York Stock Exchange open Monday morning at 9:30. It closes each day at 4, and at Friday closes at 4 for the remainder of the weekend. Tokenization will change that. There are now applications that allow you to settle and make transactions 24/7, 365, and allow you to get lending immediately off of that. So unlike securities that might take a day or two to settle, you'll have instantaneously settlement and allowed to trade whenever you feel like you feel like trading. And then lastly, we'll talk about Bitcoin. Bitcoin investors have dramatically changed over the last 3 to 5 years. Um, if we had this conversation 5 years ago, most of the Bitcoin transactions were involved with individuals on some type of technology platform, whether it be Coinbase or Anchorage or Galaxy, and they're making transactions with themselves. Fast forward to today, the consumer of Bitcoin is much, much bigger. You have endowments like Ivy Leagues. Harvard owns Bitcoin. Brown University in their endowment own Bitcoin. The world's largest sovereign wealth fund, Abu Dhabi, has $500 million position in Bitcoin. You have ETFs. There were 10 that were approved in January of 2024, and collectively they have been the single largest raise up in ETF history. You have governments like the US and China amassing Bitcoin positions. And you have corporations like Tesla and MicroStrategy, which is the big one, and even the latest IPO, which was the biggest in history, SpaceX actually has an allocation to Bitcoin on their balance sheet. So the consumer profile of Bitcoin has dramatically moved upstream, and institutions are fully embracing a Bitcoin position in their overall allocation. Let me come up for air and see if there's any questions that went into the chat on that, Justin, because that was a lot of information, but hopefully that gives you a flavor for what's happening not only in Bitcoin, but in the overall ecosystem in general.
Yeah, so as I mentioned earlier, there's a Q&A section at the bottom. It's open, so feel free to type in any questions that you may have while Kevin's taking a little bit of a break here. Nothing yet, but if something comes up, Kevin, I'll let you know.
Okay, perfect. So Sarah, if we could go to slide 13, because I think it begs the question, should I consider this in an overall portfolio? We're going to isolate Bitcoin on this one. There are ways to get exposure to a variety of different assets, but I think Bitcoin is the figurehead. So I think we can talk about this for a little bit. Um, Although future returns don't always repeat themselves, you can see on this chart that this is updated for a 10-year period through April of 2026, that when you compare Bitcoin to other traditional asset classes like US equities, like gold, like in international equities, and even oil, you can see that on a 3, 5, and 10-year basis, it has been far and away the best performing asset. And although it can be volatile and it does have times of significant drawdown, if you're in it for the long term, over a 10-year period, it's had over actually a return of over 16,000%. And the reason I bring that to your attention is Bitcoin is now in the top 10 largest market cap assets in the world. So if you're simply ignoring it, it's actually an active decision. Doesn't mean that it's a wrong decision, but it means that actually, from a market cap standpoint, you're eliminating one of the largest assets out there that is now investable via ETFs. Sarah, if you could go to slide 14. This talks a little bit about correlation. So the tenets of investing are basically asset allocation and diversification. And what's prudent to do in most cases is to add things to traditional stocks and bonds that actually don't behave and act in the same manner because they're influenced by different factors. US equities are generally influenced by dividend growth, earnings growth, change in CEO, things of that nature. None of those factors actually influence Bitcoin. What influences Bitcoin is regulatory factors, institutional adoption, global adoption, etc. So when you look at Bitcoin, which is in the middle, it's generally been about half correlated to the S&P 500. And it basically has no correlation to a traditional US bond portfolio. So from a basic allocation standpoint, Bitcoin, because of its lack of correlation, might make sense to go ahead and add to a traditional stock and bond portfolio. Sarah, if you could go to slide 15. And this is the last one I'll say about this. Um, you don't have to have a big exposure to Bitcoin for it to have somewhat of a positive impact. So what this slide basically is illustrating is if you had owned Bitcoin for the last 12 years and you did rebalance your portfolio each quarter, it starts with a basic 60-40. You had 60% in equities, you had 40% in fixed income, and over that time frame, your cumulative return was about 124%, and that annualized out at about 6.8. You had a volatility measure of about 8.47. Let's assume you actually said, I'm going to actually take 1.5% out of my equity bucket. So instead of having 60%, I'm going to have 58%, 58.5%. And I'm going to take 1% out of my fixed income bucket. So instead of having 40%, I now have 39. You didn't really disrupt all that much. And you took that 2.5% variance and you put it into Bitcoin in conjunction with the rest of the stock and bond portfolio. You can see in the middle graphic there that your cumulative return over the same time frame increased from 124% to 181%. That annualized out at almost 2% a year to the good. Now there's no free lunch, right? Did my volatility dramatically increase? And you can see that it really didn't. It went from 8.47 to 8.85. So it wouldn't give you that much problem sleeping at night. And the 2.5% can be additive as opposed to disruptive to an overall diversified portfolio. When you get above 5%, it starts to have bigger impact. And when you get into 10%, you can see that the volatility dramatically increases. So I think the takeaway there is if in fact you are considering investing in digital assets, specifically Bitcoin, you want to risk size it properly. It probably warrants a 1 to 2.5% position depending on your particular goals and where you are in your overall investing timeline. Last comment, Justin, and then I'll turn it back to you for some questions, is the world is much more accessible than it was even 2 years ago. 2 years ago, in order to invest in any digital assets, you had to do it on your own. You had to link your bank account to some type of technology platform, which in some cases causes a fear factor. So you had to go through Coinbase or Anchorage or something similar. And now, because of the approval by the SEC to allow ETFs for really any exposure you want to get, you can hold that right in your own brokerage account. You don't have to worry about safeguarding it yourself. It would be part of your collective portfolio and is now part of the overall financial picture. So Justin, we won't get into specifics in terms of what they are. We certainly can, but I'll turn it back to you because I know we wanted to go about 15 to 20 minutes. I think we went 18 and see if there's any Q&A from there.
Yeah, thank you very much, Kevin. So the Q&A is open again. Feel free to send some questions in. There are a couple that have come in. So question number one we got here is, isn't Bitcoin primarily used for illegal activity?
That's a great question. And the media loves to portray that. And candidly, 15 years ago, when Bitcoin was created, I think that that was probably a fair question. Um, After all, it was not regulated. Um, Enforcement agencies really weren't sure what it was, right? So they weren't really sure how to catch up to that. And that has dramatically changed these days. And what really drove that is in 2019, the US said any exchange that actually allows digital asset transactions has to institute KYC or know your customer rules and AML, anti-money laundering rules. Those are the same exact rules that banks institute and brokerages institute. So now you know exactly who the owner of that account is and where and what activity actually took place, combined with the fact that law enforcement agencies have dramatically caught up, right? So they now know exactly how to follow the trail of Bitcoin. And what that leads to is Bitcoin is now a terrible tool for criminals or nefarious activity because it's an immutable ledger. You can follow any life path of a Bitcoin, where it went into what wallet it went into. And in 2026, there's an independent enforcement agency called Chainalysis. And they did a study and they basically said that In 2025, illegal money laundering activities in US dollars was about 2% of GDP. And in crypto overall, Bitcoin and the like, it was actually under 1%. So maybe 10 or 15 years ago, that was a valid comment, but today I think it's really stale.
All right, great. Next question. Is Bitcoin too volatile to invest in?
Volatility unto itself is not a bad thing. It depends on how you harness it. So Bitcoin has definitely been a volatile asset. There's no question about that. Because of the on-ramps of ETFs and the consumers that are in the market buying every day that were not there 2 years ago, the volatility profile has come down. Does not mean it actually has been eliminated. Last year, in 2025, Bitcoin had the same volatility profile as two of the most widely held stocks out there, Nvidia and Meta. And I think the takeaway there is in isolation, Bitcoin can be volatile. If you combine it in a well-constructed, diversified portfolio and you risk harness it, like we said at 2%, it can be very additive to the portfolio as opposed to disruptive.
All right, next question. Why is Bitcoin compared to gold and often called digital gold?
Yeah, that's a good question. There are certainly some similarities to Bitcoin and gold, and there's certainly some benefits to both, and there's some pros and cons to both. Um, Neither one of them is controlled by a central bank or government, right? So there are investors out there that want an asset that's not totally influenced by the US Fed per se. They both have a supply cap, right? There's not an unlimited amount of gold in the world. And what a lot of people don't realize is there's not an unlimited amount of Bitcoin either. There'll only ever be 21 million. There's a protocol in terms of how that's mined. The final Bitcoin will not be mined until the year 2140. So we actually have a ways to go. But when you look at Bitcoin and new supply coming in, um, Bitcoin miners, without going too much detail, get rewarded with 3.125 Bitcoin each time they are rewarded for solving a block. Blocks happen about every 10 minutes. There's about 144 blocks happening each day. So there's 450 Bitcoin that comes into new circulation each day, which equates to about 165,000 new Bitcoin if you do the math out to a year. Because of the scarcity element and the imbalance of demand over supply, the US ETFs alone are buying about 275,000 Bitcoin per year, and only 165,000 are coming into supply. So there's a big benefit right now between the imbalance between demand over supply. And the last thing I would say is the benefit of Bitcoin over gold is Bitcoin is a much easier store of value to divide, to send globally, and to store. Because obviously none of those elements really exist with Bitcoin.
Next question. Can a stable coin be used to move money from Australia to USA, or really any country to another country? If so, is it subject to exchange rates?
The answer is yes, it can be moved, and exchange rates, it would be. If I understand the question, if there's a difference in value between the Aussie dollar and the US dollar, would that be accounted for? And the answer to that is yes.
Yeah, so I think it's a question of where it's purchased at, right? So if you're converting Aussie dollars into a stable coin, there will be an exchange rate at that point in time. To simply transfer that stable coin to another country, I don't believe is a exchange rate issue because once it's in the stable coin, it's effectively in treasuries that are obviously backed by the US. Next question. Does Bitcoin have the key properties of money?
That is a good one. Um, I think a lot of people struggle with that question, Justin, and rightfully so, because there aren't a lot of things in the US or globally that you can purchase with Bitcoin. There are a few. Um, I think of it this way, and this is how Bitwise thinks of it. Um, we have a benefit here in the US that if you step outside the borders, a lot of other countries don't have the benefit of. We don't have the fear of waking up tomorrow and the value of the US dollar plummeting 30%, hence the value of our bank accounts and checking accounts being down 30%. I'm knocking on wood, but we don't have the fear of hyperinflation or a lack of trust in our government for the most part. So that is one reason why outside of the borders of the US, folks turn to Bitcoin as an alternative to combat some of those elements I just mentioned. Um, the second thing is, I think of Bitcoin more as a service than a currency. And I'll put it this way, no different than Microsoft. I'm going to use Microsoft because a lot of folks use Windows. Microsoft, the more people that use Windows, the value of Microsoft stock goes up. If less people want Windows, the value of Microsoft will come down. If nobody wants Windows, Microsoft could be worth nothing. Bitcoin has the same characteristics. There are folks and investors that want the ability to store value digitally in an asset like Bitcoin that's not controlled by a central bank or government. As I mentioned, Harvard wants that service. Brown wants that service. BlackRock wants that service. Uh, the more people that want that service, the value of Bitcoin goes up. Less people want that service, the value of Bitcoin comes down. If nobody wants that service, you could argue that Bitcoin be essentially worth nothing. But if you kind of insert service versus currency, I think it brings a little bit more to life from that standpoint.
Yeah, so I'll add to that a little bit. Um, One of the key properties of money is scarcity, right? And I would say that dollars are not in short supply, right? We've learned over the last couple decades that, the government from a fiscal standpoint is willing to spend like drunken sailors. I mean, we have $40 trillion worth of debt. On top of that, from a monetary standpoint, the Fed is more than willing to accommodate that spending by issuing treasuries. So when we think about, again, one of the key properties of money being scarcity and the fact that our dollar, we've seen from recent history, is not scarce, it fails one of the key characteristics of being money, right? So over the last 50 years, the dollar's lost roughly 90% of its value. So when you're talking about an asset like Bitcoin that has a hard cap, and is finite in nature, it solves for that scarcity issue.
Yeah, I would agree.
All right, next question here is what is the difference between Bitcoin and Ethereum?
Love that question because that really pinpoints that all crypto assets are not the same. As we've talked about, Bitcoin is fairly one-dimensional, right? It has a supply cap, has a scarcity element. You have the ability to divide and transfer it globally, settles like a text message. Ethereum is completely different. I think of Ethereum as a technology platform, not as a cryptocurrency. And the reason I say that is Ethereum is a layer one network that you have the ability to put applications on top of. I think for this discussion, a good analogy is your iPhone. So when you looked at Apple services last quarter, 24% of Apple's earnings had nothing to do with iPhone sales or iPad sales. It had to do with their services. What is that? It's actually the applications that vendors put on top of the iOS operating system in order for you to access via your iPhone. So you might have Starbucks on there, you might have JetBlue, you probably have your bank. Ethereum is the same thing. You can layer applications, whether it's in finance, whether it's in car titles, whether it's in real estate transactions, on top of Ethereum. Stablecoins. 70% of stablecoin transactions are currently happening on the Ethereum network. And the more applications and the more transactions that actually occur on top of that network, the value of that native token, in this case ETH, goes up. So unlike Bitcoin, Ethereum does generate cash flows via the applications that are layered on top of it.
All right. If there's any last questions, feel free to type them in here. But we're butting up against 12:30 here, so I just wanted to say thank you, Kevin, for joining us today. Thank you for all the valuable information. To everyone who's online here as an attendee, feel free to give us a call if you have any questions or follow up from this meeting. I do realize that this was a very high level and quick overview of the digital asset landscape. So there's certainly, more to talk about in detail. Thank you, everyone, and we'll close it out for today.
Thank you, everyone. Thanks, Core Capital. Talk to you soon.